Hello everyone, George DeSantis here with a look at the market for the week ending April 3rd. That's Friday, April 3rd, 2020. And before we begin, let me do the usual, bring up this disclaimer, invite you to take a look, read it, and realize that I'm not an investment advisor. Basically, I do this for my own purposes and post it as a YouTube video. Anyone can look at it, but it's not an attempt to give any particular person advice insofar as investments are concerned. Let's begin then by bringing up a weekly chart of the S&P 500. So here's a weekly chart of the S&P 500. And for those who are new, let me just give you a little briefing to understand a little bit of what we're talking about here. This yellow line is what we call a 4 exponential moving average, a 4 period. In this case, it would be a 4-week exponential moving average. This red line is a 9-week, in this case, exponential moving average, and this green line would be a 30 weighted moving average. Now, we look at the relationship between these moving averages as one measure, as one indication of whether or not we are in an uptrend, downtrend, or otherwise. What we see here back in February, this would be back in February 21st, is we had a parabolic. This parabolic stop and reverse indicator was below this bar, and so it was still indicating an uptrend. But then the following week, the parabolic switched to being above this bar, which was the bar of the next, February 28th, I believe it was. Yes, and at the same time, the 4 exponential moving average crossed below the 9, that red line, and the 9 crossed below the green line over here. So we were getting a breakdown of the market right here in there at the end of February, as most of us, in hindsight, we know now. But this chart and others, daily chart, etc., were giving us some heads up, was giving us a heads up as what's to come. So what else do we see here? We see that after breaking down here, we came all the way down to this level, this low here. These 3-week bars are very important. First of all, we had a low here on a bear bar, on a bearish bar. Then we had a bullish engulfing candle, and I recall mentioning that this gives a little glimmer of hope for bulls, but not to get too enthusiastic about it because there are so many other bearish indications. We are still in a bearish downtrend. Well, let's take a closer look and see what else we notice here. Well, this white line is the 200-week moving average because it's a weekly chart. Sometimes I refer to it as a 200-day, but it's a weekly chart, so it's a 200-week average. And you'll notice that the high, this green line here, the high of this bar 2 weeks ago hit just at that 200-day moving average, pulled back. It got rejected here. In other words, there was resistance. It pulled back and then closed at this level. Now, in addition to that, you can see that this past week, this was 2 weeks ago, past week, same thing happened. The high of this bar last week hit the 200-day, 100-week moving average and pulled all the way back. It got rejected. We are finding resistance at this level. And folks, what is this dotted line? This dotted line is where the first major Fibonacci retracement level is at. That's at 38.2 level. So we are at here at about 25.59. Let's see what level it was at. It was about 26.65 or so, 26.60. 2660, let's say, or 25.59. So it was everything just sort of like conspired to end at this level here, so to speak, running out of words. You get resistance at the 200-week moving average. You get resistance at the 38.2 Fibonacci retracement level, and we close lower. Now, if you look at the at the MACD histogram, you'll see that we're still in bearish territory. In fact, we're still trending down here a bit. And so the bears are still in charge. And if you look at this level here, if you look at Williams per centaur, I use a 30 period. Williams per centaur broke down here, and at this same level, at the week of the 28th of February, and it remains there until Williams crosses back above this, especially on the weekly chart. I think we are in a downtrend, and you can see that Jerry Appel's sum of the rate of change indicator remains below that 4% line, and so it's indicating downtrend, folks. So let's take a look at the daily chart. So here's the daily chart of the S&P 500. Let's start from the top. Remember I said last week that Oscar Carboni pointed out this death cross. The death cross is referred to by traders as the 50-day moving average crossing below the 200-day moving average. That was an indication that we were in a new territory. We were in a bearish, very bearish market, or at least a significant downtrend, if you believe in this phenomenon of the death cross. Now, where are we? Well, we made this low, as we saw, this low here, and then we rallied up. Now, when we rallied up, as we saw on the weekly chart, we found resistance here. We found resistance at the 38.2 Fibonacci retracement level, and that was exactly where the 200-week moving average was. And now we see that that is exactly where, on the daily chart, the 30-day weighted moving average is situated. So you got all these things presenting resistance to price. So price bumped off of that and went back down. That's what occurred at the end of the week. And so we might ask, well, where do we go from here, of course? And I think we go lower, frankly. That's a lot of resistance that we found here. And you notice that the parabolic is now approaching these bars. So if that is the case, parabolic is likely to move above the next bar, giving us a further indication of a downtrend. Now, if we move to the MACD histogram, you could see, well, we are in bullish territory, and you could see parabolic was indicating up until here anyway, that we were in a daily uptrend for a while anyway. You go look at Williams per centaur. Since we broke down here, we haven't really breached this magenta line again, so we are still in this downtrend according to the Williams per centaur indicator, and we can say the same thing pretty much for this sum of the rate of change indicator on the bottom of the chart. So let me tell you, I don't own any stocks. I'm doing short-term trading. I'm looking to do very short-term trading, day trading. It's not for everyone, but I've been pretty successful with it. And I don't see anything to buy here. I don't see too many things to buy. We'll take a look at some individual stocks in a short while. But let's continue looking at some of these other charts of the S&P. Here's a daily chart of the S&P on the Ishimoku cloud chart. And you can see that the prices broke down below the so-called cloud, which is this area here. Broke down here back in February, as everything indicates we did. And it's now trading in this range here. You can see that resistance level at the 38.2 Fibonacci retracement. But what's interesting is the cloud is projecting a downtrend here. So bear that in mind. Now, if you look at Jake Bernstein's chart, one of his charts anyway, I put it on TC. I'm not saying this is what he provides, but I put what he discussed on this chart. Anyway, what you see here is that resistance. It came all the way down. But what I wanted to point out is that the Williams, he uses Larry Williams' accumulation distribution indicator. Williams' AD line crossed above the average way back here. Again, that was really in October 19, and it's crossed here again, crossed below the average on February 25th, like everything else, when we had that breakdown. In order for us to be back in this market, what does Jake Bernstein's chart have to show us? It has to show us two successive closes, two complete bars above this 10-day average of the highs, and this accumulation distribution line has to trigger a buy signal. It has to go above the moving average, the 57-day moving average, and trigger. This is the trigger. Once you get two bars above, you need the trigger. We didn't get the trigger here. You can see that even though we got two bars here, there was no trigger, so you don't buy. So that's what we're looking to see. One of the things anyway. It's not the only thing, of course. Now let's look at some of those stockcharts.com charts. The first one here is Apple. You can see this breakdown here. As you know, I owned it all the way up and then sold it somewhere in here, together with Microsoft. Anyway, what Oscar Carboni is suggesting is, OmniSystem is suggesting is, sell the rallies in Apple. That's his recent email. So I don't know, he could be right. If Apple rallies, sell it. That's not good for the market. Here's our chart we've looked at before. It's one that Alex Elder likes to look at. You remember that chart where we saw the new high, new low index? And he says when we spike down like this and we go above 4,000, we're likely to get a nice rally. Well, so far we haven't done much of anything. And I'm a perennial bull, but not in this market right now. I don't see it happening right now. Here's another chart, the chart of the S&P, the daily chart. What we're getting here is a red bar. This is the impulse indicator. The red bar is telling us we're not allowed to go long. We're not allowed to buy. It's a censoring system. So it's saying you're not allowed to buy the market here. Here's a chart of the percentage of stocks of the S&P 100 above their 200-day moving average. You can see it's still way below 50%. We need to see it go above 50% before we can begin to feel confident about buying this market. At least I am. And before we take a look at some individual stocks and so, let me mention, of course, that the VIX, for example, is coming down. I mean, it made a high of about 80. Now it's at what? Where is the VIX? The VIX is at 46.80. So we've come a long way from the high of the VIX. And usually when the VIX starts coming down, you want to be looking to get back in the market. But right now there are too many other things, as I mentioned so many times, that are working against that scenario. Now here's our short list of stocks that I thought were, in spite of the fact that the general market is looking so weak, they showed some signs of life, like Kroger. I owned Kroger for a while, and you see it showed some life. Now it's oversold. If you really have to buy something, and that brings me to another point. Alex used to say, George, you must wait until a stock holds you by the collar and shakes you and say, George, you must buy me now. That's when you buy. And Warren Buffett says, hey, they don't count balls and pitches, so you don't have to swing. Wait till the ball looks as big as a watermelon, and then you swing. Can't miss. Don't buy because you feel you have to buy. So I ain't taking the bait. So here's a short list, and you can see Kroger is up. But besides that, and you see it's oversold. So you want to buy these stocks not when they're overbought. Most of them are overbought. And Kroger is one of the few that's oversold. Ring is overbought. Let's go down the list here. CTXS, Citrix, overbought. DocuSign, overbought. So most of these are overbought. Okay, Zoom was overbought. It's going up a little bit now. Anyway, folks, that's about it. We're out of time. Keep well. As my niece says, this is an evil son of a bitch virus, okay? Nobody ever put it as better than that. So stay away from it.